Is this the worst time in history to invest, or is it the best time? In today's video, we are going to talk about the facts, help you get the answer to that question for yourself. To me, this is an opportunity of a generation to get involved with investing. And in today's video, I brought on a good friend of mine, an absolute expert in the world of passive investment, to talk about this very topic. Before we get into that, I want to welcome everyone back to the channel. I'm your host, Dr. Jonny Walker, aka Jonathan Withanachchi. On this channel, we help dentists achieve true financial freedom through passive investment in real estate and alternative investments. Without further ado, I want to bring on our very esteemed guest, Mr. Badawi Dweik of Bluestone Flagship Investors. All right, guys.
Good morning.
Settle down. Okay, so Badawi is a very frequent guest on our channel, and with very good reason, right? He's a guy I hold his opinion in very high regard, and I enjoy our discussions on investing, which we have every other Friday. We meet like clockwork every other Friday on Zoom call, and we talk about the world of investing, what opportunities we're seeing, what we're talking about. And I want to share some of those nuggets with that knowledge with you guys here on this channel today. Badawi Dweik, thank you back. Thank you for being here again. Good to see you.
Yeah, no, thank you, Dr. Jonny. Great to be here again, especially on this fine morning of a Friday the 13th.
It's Friday. Oh man. Okay, guys, this is a special episode. It's not Friday the 13th at the time of the recording. All right, Badawi, let's get right into it today. Right. So where are we in the investment cycle in 2024? We want to take a look. We want to kind of go in and give the people a market update and a deeper look into investor fundamentals. Are we in a boom? Are we in a slump? Are we in an economic recovery? Badawi, where are we right now in this investment cycle in 2024?
That's great. Actually, probably want to even narrow it down a lot further, because people talk about investments as in stock market and a whole lot of things. Sure. I just want to say, just for real estate, just for commercial real estate, what would be some of the factors that we're seeing to really determine what part of the cycle are we in, the investment cycle into the commercial real estate, where really is typically a lot of our discussion. Everybody know what a boom cycle is. Everything is going down. A slowdown is kind of the next thing after the boom, which typically happens when you start seeing interest rates going up, things like construction prices dropping, basically start to increase. The next cycle after that is kind of what we call slump, which happens typically after the downturn, after the prices have corrected, which I believe this is the cycle that we're in right now. And typically after the slump, things starts to recover, and that's really the recovery, and then you have a boom again. So really in real estate, or in several different markets, there's the boom followed by the slowdown, followed by the slump, and then the recovery. And the challenge is for investor psychology. Typically, in a boom, everybody's like bullish and want to invest, and as it starts down, the number starts looking a lot worse, or maybe there's capital calls, or maybe cash flow stops. But it's really about controlling the sentiment as you start entering the slump, because at that point, its sentiment is even worse, right? Because you just went through a slowdown. And it's like, what would be some of the factors you would want to look for that you are in slump, to determine that you are in a slump? Because this is the time to really transact, as an investor, even though it might not be the right sentiment. So you can really get into you really can benefit from the recovery and the next boom. And it happened to me, frankly, back in 2010, 2011. Again, I was a tech guy, working as a computer engineer with chips and everything else, but I was always a real estate investor. I was owned by it. And in, 2008, everything was shaking. People were losing a lot of their equity, a lot of stuff. Really, for me, what really made my difference in my real estate portfolio is really recognizing that slump. And the sentiment was horrible back then, but the slump is really when I started acquiring a lot of my short sales. because market has corrected and all that. And from 2011 till 2020 is really when the recovery and the boom happened. So it's really about how we recognize that we are in a slump. And typically the sentiment isn't high because everybody has gone through a slowdown where it kind of affected the mood. So, and then recognizing, hey, this is the time to really buy because we are in a slump. So where are we in 2004? I think we're entering the slump phase at this point.
Yeah, so that was great.
And
a lot of gems you kind of talked about there. I want to circle back to one of them, which is you mentioned that, hey, look, there's a boom, there's a bust. You're talking about cycles, right? And one thing we have to recognize as investors is that there's a cyclicality to any type of investing that you do, right? Whether it's in stocks, whether it's in real estate, there's cycles. And that's one thing to recognize, right? There's not, hey, things are always going up or things are always going down. No, there's always periods of booms and busts, and those are driven by different factors. You touched on one of them, which is interest rates, obviously supply of product, demand for a certain type of product. For example, multifamily. Hey, if you got a lot of people moving to a place and there's not much supply growing, then that creates natural economic forces, right? Where you have rents rising, values rising. Where you have the opposite, where maybe there's an oversupply of units, maybe they've built a whole bunch of units like in some major cities in China, and they built hoping that the demand would follow. The demand isn't there, there's people there, the units are empty, and now this puts downward pressure on rents, which puts downward pressure on values. So understanding there's a cyclicality to every type of, and even within each asset classes, there's cyclicality, right? Meaning like multifamily cycle, even though we're late in the multifamily cycle, might not exactly coincide one for one with, say, mobile home parks, for example. Another example that came to mind is self-storage. Self-storage was the talk of the town a couple of years ago, right? 2021, 2022, especially post-pandemic, you saw major interest in self-storage. But then now we've seen a record level of self-storage units come online because self-storage is also one of those type of asset classes that are very easy to build quickly, right? Less permitting, etc., than a multifamily structure. And now we've seen self-storage a little bit of pullback, right? Where we've had oversupply, we've seen some things start to level off. So cyclicality is very important to know. And the other thing you mentioned, BD, is the psychology of the investor. It's counterintuitive investors' sentiment, right? Because when things are booming, okay, I wouldn't say counterintuitive. It's actually intuitive to say, hey, look, everything's going up, I want in too. But when you're at the height of the market is also when private equity is also at its peak. Everybody wants to get in because things are at and people start overpaying for things at the top. And that's very ironically one of the worst times to be investing, right? And then we go around, interest rates have gone up historically, sales transactions have fallen off a cliff. We've seen asset values are coming down in certain places, right? Rents are even going down in a lot of primary markets. We're late in say, take multifamily real estate, for example, we're late in the cycle. On top of that, we've seen people that invested in syndications, right? Syndications popularity blew up in 2020, during COVID. Right? People were at home and they were like, hey, look, what things I can invest in. And then we had the stimulus, we had all this cash in the system and everything's going up. But now things have gone the other way, right? There's capital calls, people have paused distributions, some people have gone through foreclosures, they've lost money. They're like, what the heck is going on? I should have stayed in the stock market. But that's the wrong sentiment, right? This is probably when everybody else is now pulling back. I'm not doing those type of investments anymore. There's too much risk in it. I want to wait and see what happens. Interest rates are going to come down. There's too much it's too much of a tumultuous time in the market. I'm going to step back and stay out during this time. But that's one of the biggest mistakes that you can make, right? Because when sentiment's at its lowest, private equity's at its lowest, investors are investing less. There's less sales transactions happening. This creates a buyer's market all of a sudden, right? And people tend to pull out at the worst times, and they want to come in at the worst times. So, BD, what do you think about that, right? Like, what do you think about now in terms of an investor? Is this a time that an investor should be stepping back, or is this a time where investors should be looking to become more active? What are your thoughts about that?
I think you said it extremely well, Dr. Jonny, and it's really about recognizing, just think about it from a buying and selling, and really recognizing when is a buy market and when is a sell market. If it's a buy market, I want to be an investor, right? Because money in real estate is made on the buy. The cash out is really on the sell. And like what are those signs in the market that, hey, the market is down, and we're entering that slump? It's already come down and it gets slumped, and it's right before actually you get the recovery. And you mentioned it, rising interest rates. We've already seen that. Check. Expenses rise. We're already in an inflationary environment. Even in multifamily, property taxes, property insurance, everything else is rising. New construction and delivery. Yeah, we've seen that. Check on that. Softening occupancy. We've seen that softening of rent growth. Remember, 2 years ago, rent growth was going, 8-9% every year. Right now, we're looking at rent growth minus 0.75, in the specific submarkets that we're looking at interest. And again, everything is specific to a submarket when we're looking at the deals that have the fundamentals that we want to invest in. That being said, just as a passive investor, what are some of the things? For example, some of the things that affect a lot of the sentiment is distribution. Distribution pause. Yeah, that's actually is just another sign that we're going through that downturn and trying to exit out of it. Capital calls. And so as I speak to more and more of our investors, they all get into this panic mode, and I'm like, okay, these are all great buying signs. That means, hey, there are going to be some higher vacancies. We're already seeing some properties being distressed because loans are being redone. People are literally acquiring them with whatever the bank owes on them, which is great buying opportunities. That means they're buying with a lot of equity into play. And everybody right now expecting interest rates to start going down. And we probably covered that on the previous episode, that how interest rates goes down, it actually cap rate compresses. That means people is going to start to pay more. We've already seen a confirmation because the average dollar per unit in a submarket like a Dallas and everything else is already bottoming out. It kept going down from 160 to 150, 140. Right now we're seeing it about like 115K, 120, 115K for a Class B asset. And so all the metrics that we would look for in terms of a down cycle is already been checked. So right now we're like, okay, do we expect things to get into that slump mode? And what do we need to do as investors? Build the confidence to find really the best deals to place our bets. This is the time to place the bet. And then really it's about, sometimes overriding the psychology, which is, like you said, counterintuitive. But hey, let's look at the data. Are there fundamentals? Is these things like a Dallas market, is that something that's going away, or it does still have the fundamentals? Yes, it has the fundamentals.
Yes.
Have we seen all the slowdown? Have we seen the price correction? And, are there specific deals we want to take positions in right now, apply new bets on in order to ride the next wave? And that's really, what we would want to look for as passive investors is ensure that, hey, we've passed the slowdown, things have, slowed down in terms of prices. Like I have seen kind of prices have stabilized. Mm-hmm. There hasn't been too many transactions to say, yes, we've seen many, many transactions, but we definitely see, and we feel like cap rates have already softened. So this is a great time to get in and ride the next path of recovery. And then like what recovery would mean is once we're in, rent starts to increase in a recovery, vacancy starts to go down in recovery. This is what recovery would do. But if we already see that and then we want to invest, it's kind of already late.
Too late.
So for us, really need to kind of recognize some of the signs that slowdown has ended. We're in that slump. Let's take a position so we can really take advantage of that recovery and then followed by it.
Yeah, I mean, I think I read it yesterday. right? The majority of recessions happen in a 7-month to 20-month type of time span. And then you have constant expansion for 7-8 years. And then we go back to a recession for 1 or 2, 3 years. And then we have 7 years of expansion. That's usually how these cycles go. I think I agree with you. I think we're near the bottom, right? I also believe that this might be, if you can get into places like Dallas, the fundamentals have not, let's look at things from a macroeconomic perspective. Let's just consider data. Let's look at that. People continue to move to Dallas in droves. That is a point. That is a fact. That is an objective fact. Companies continue to headquarter in Dallas. Dallas is the headquarter of headquarters. It's gotten that. That is a fact. That is not changing. So if we know that the fundamentals are median income growth and population growth and job growth, which we're having all of those things happening in Dallas, and we have the ability to say, let's take a look at even a Class A product, and we're able to go buy Class A prime real estate in Dallas at a 6 cap, 6.5 cap, I would say that, and you can get it to pencil today. Show me a time in the last 15, 20 years, BD, that Class A property in prime markets traded at a 6.5 cap. Right? It's
exactly.
You don't see that happen. What we're seeing right now, I'm telling you guys, it's unprecedented, right? Like, this is the best time. Hey, we can get in if it pencils today at today's interest rates, and we can get it to at least cash flow or maintain, and we're entry at a 6.5 cap. We're only putting ourselves in a great place of great tailwinds, right? Because we know that, hey, look, the pendulum is about to swing back the other way. We're about to become the recovery phase, and then it becomes an expansion phase, and the market starts to boom again. The people that are getting in and buying a bunch of stuff at 6 caps, 6.5 caps, 7 caps in some primary markets, and just riding the wave of macroeconomics, that'll put you in a very, very favorable position, right? Even if things might not even go, even if things are just average at the operational level. And hey, look, these guys can at least just get by and make sure this thing cash will get by. The fundamentals alone of the macroeconomics should really raise the levels of returns for investors. What do you think about that, BD? I mean, I think now is a time to get in as many deals as possible before we start seeing these things start to change, right? And now we start getting investors get interested again. You know, interest rates start coming down, cap rates start coming down, more equity starts following, prices start going up again. And again, there's still ways to make money in no matter what part of the cycle in real estate you are. Real estate is such a multifaceted, beautiful asset class, that you can invest and make money in a downturn or upturn. But if you can recognize macro data and invest in submarkets and markets and submarkets, with strong fundamentals, I think you put yourself in a very favorable position to do very well as an investor. What are your thoughts there, BD?
Absolutely. I think the fundamentals is key. Choosing the submarket is key. And just like you said, for example, we're still very bullish on Dallas as a market from fundamentals. And
yes.
And then when we look at
you're bullish on Dallas despite rents going down 1.5% in Dallas, right?
It's true.
How did rents go down in Dallas? How did rents go down in Dallas? And a sophisticated investor like BD is saying Dallas is a great market, right? This is understanding the fundamentals. This is what it comes down to. It comes down to overcoming the psychology of the investor, right? The psychology of this is what we're trying to drive home in this video today, right? Is don't follow the sentiment. Don't follow people's emotions. Consider the data. Consider history. There's always windows of opportunity where a lot of savvy investors, BD, I see that they don't buy anything for 7, 8, 9 years, and they don't invest forever. And then they come to a time like 2008, and then they go on a spending spree. right? They go binge shopping, and I know guys that, hey, we have American real estate is on sale. There's a couple from Australia came and they went to Phoenix and they bought $2 million worth of single family homes in a weekend with an average price of $30,000, right? Those people are did very well in just in a 3-year period. Prices recovered and they made out really well. So my point is, don't let emotions get in the way of sound investing. And 2024, I think this is one of the best times in history to get, or at least in a generation, to start. If you haven't gotten invested, if you haven't started investing, this is an incredible time and opportunity to get started. BD, any final words before we land the plane here?
Yeah, no, absolutely. I think the fundamentals there, the signs that the market is getting us in terms of being a great market right now is there. And really, Dr. Jonny, what you do with your group, being able to vet the deals and figuring out, hey, are these good deals? Are these good buys? Working with sponsors like yourself, and it is instrumental for a lot of passive investors that don't have the know-how to kind of go and chew in on a whole lot of data. But from our standpoint, with our investors, we're saying, hey, we're seeing all the market signs that there's a buy at this point. There's a buy, and we're really being very picky on the deals, making sure the deals are vetted well and
yes,
and they can stand on their own. And really, it's just about capitalizing. One last thought, and we mentioned it before, money is really made on the buy. And like for example, I'm desperate looking for office, but again, I'm not looking for office with hoping to fill it back as an office, but maybe converting regular office into a medical office. And again, that's a higher risk investment. But just keep in mind,
and BD, that's such a contrarian view, right? You're like, I'm looking for office. Everybody else is like, then the exact opposite, right? Exact opposite. Office is a time bomb. There's all these issues. And people are completely looking the other way, right? But then guys like BD are like, this, when everybody else is not looking, this is when the best opportunities are there, right? Like go on with that, BD. Sorry to interrupt you there, but I agree with you. I mean, suburban space is like incredible. Office buildings are incredible buys right now, especially when you buy them at discounted rates, right? Converting different uses.
And that's the thing.
You were talking about converting office to medical.
Yeah, and then what we've seen is an actual medical group, which is a bunch of doctors in a medical group, have really recognized this opportunity, and they are buying office at 40 and 50 cents on the dollar because it's vacant, it's in distress. They're literally picking up office. They are moving their practices in the office, and in about writing a triple net lease between their medical practice and the building, and the property, and then going to the bank and doing a cash out refi at a much higher cost basis at about they're getting basically cash out refi at 65% leverage on the whole dollar. So imagine you're buying a $1 worth of an asset at 40 cents, and you're structuring your lease, and then at some point you're going back to the bank, and the bank's saying, hey, this is valued at $1. I'm willing to give you about 65% leverage. You're taking that money and you're acquiring more office and bringing more. And these are the type of opportunity, for example, right now is exactly looking actually for a lot of those private equity medical groups that are trying to do these these type of things. I'm not suggesting people jump into an office just to keep it as an office, but there are opportunities. And really, I brought this as an example that I've seen right now, where people that are savvy, they understand that, hey, when there is a distress, this is the time to buy. Everybody running away from office, but there are people that have a business plan, and a goal. And really, like I said, money's really made on the buy. And it's just another example. We always talk about multifamily because it's just easier to understand, but I think there's an opportunity in every subsector. It's really about, is there a solid business plan behind all of this, and are there fundamentals for it? But yeah, I just wanted to mention this because when I saw some of the numbers, what some of this private equity medical group is doing, it really blew my mind, actually. That they're picking up something at 40 and 45 cents or 50 cents on the dollar.
That's on sale.
And then literally in 6 months, they're going to the bank, getting a valuation at the full dollar. Yep. And then doing a cash out refi. It's almost like they have no money in the
building for free. Unbelievable. Well, you guys, you have it here.
And that's what savvy investors do. That's what savvy investors do.
You have to be a little contrarian, right? If you follow the herd, you're going to be a sheep, right? So sometimes you have to be able to break away from the herd and think a little bit outside the box. And those of you that will do that in 2024 will be very greatly rewarded. All right, guys, that's all the time we have for today. I want to thank our guest BD again for joining us. BD, if the people want to learn more about you and what you're doing, what's the best place to do that?
Yeah, absolutely. BFI, Bluestone Flagship Investor, BFI-fund.com. I'm also on LinkedIn, B Dweik as well. Happy to chat and always bounce ideas, and always happy to be a part of your platform, Dr. Jonny. It's great, the exchange that I look forward for our exchange every 2 weeks to really kind of calibrate on what's happening with the market and various different things. So thank you for having us on your platform, and we'll hope this was good value for a lot of our investors.
All right, guys. So if you had any value, drop a fire emoji, like this video, and please do share with any like-minded colleagues or anybody that you think could get help or value out of this. That's our goal. And we'll see you back again next week. Same place, same time, with more exciting content to keep the information flowing and your bank accounts growing. I'm Dr. Jonny Walker. Peace.